You've bought your whole life policy, and now you're concerned because you see that the guarantees disappear and there's no cash value or death benefit after you're 65.
You are listening to Wealth Talks, and today a request has come in for us to talk about 1035 exchanges. You're going to get to hear about that today. But first, we're going to be doing a workshop in Atlanta, Georgia. It's going to be an afternoon workshop from 1 to 5, Saturday, May the 4th. Be sure to check that out on the website if you're in the Atlanta area. So getting back to the 1035 exchanges, what is a 1035 exchange and how does it apply to you?
Well, the best way to think of this is to think of real estate, because most people understand how real estate works and operates. So you've got a piece of property, let's say, that you've been in for less than 2 years, and you decide that you'd really like to move into a different location. But because you haven't been in your own house for 2 years, if you sell your house, bingo, any appreciation is now taxable for you. And so the IRS has thought that through and said, if you're going to just transfer the growth that is taken in the piece of property you're currently living at and put it into another property, then that's called a 1031 exchange, and there will be no tax liability on the growth that you experienced on the first property.
So that could be done with the property that you're living in, can also be done with investment property?
It can be done with investment property too, as long as all the growth that has taken place gets transferred to the next property.
Okay.
So now, in a life insurance situation, let's say someone is into a life insurance policy like some of the ones that we've reviewed this last week, where people are going to pay over $1 million and never break even in the policy.
That's crazy.
They're not even going to have the death benefit that they've paid for. What can they do with that? Well, you can take and do a 1035 exchange into a better designed policy, and then the money that you've paid for that original policy will not be lost to you, because it will be added as cost basis into the next policy without you having to face any taxation.
Just like that 1031 exchange transferred the value of the in the real estate property, the appreciation to the next property.
That's correct.
Exactly what's happening here.
Now, some people will say, well, if there is no cash value in the first policy, what would be the sense in doing a 1035 exchange? And the IRS says it's not the cash value that they're saving here, it's your cost basis. And because life insurance is first in, first out, you can withdraw all cost basis from a policy before there's a tax liability. So you don't want to lose that cost basis in flowing it over to another policy. So even if there's zero cash value in the policy, it still is in your best interest to do a 1035 rather than just to cancel a policy and then start another one.
So the value of the old policy gets transferred to the new policy, or if there is no value, you still get the cost basis that transfers over.
That's
cost
correct.
basis, that's a technical term. That means all the money that you've ever paid in premiums for that policy.
That's correct.
So if you paid $50,000 in premiums, cash value on the old policy was maybe only 10, let's say. So the 10,000 value would transfer to the new policy, but also that 50,000 in cost basis would come with it.
And another important factor here is by doing a 1035, you're not ever in jeopardy of being without life insurance coverage. Because if the first policy still has some death benefit in it, and you're doing a 1035, then when that 1035 takes place, it's a switch from one company to the second company's coverage in a very streamlined fashion, so you're never without the coverage that you need.
Now, at the very beginning, you said something, you buy the whole life policy, but then you see the guarantees go to zero? How does that come into this picture here?
Well, some whole life insurance policies are different than others. And of course, universal and variable universal policies, we often see the cash values going to zero.
Yes.
But in a whole life policy, the premiums can get larger every year when people put term riders and things like that on a policy, and they're trying to get the policy to behave different than a typical participating whole life insurance
They're
policy.
tacking on those extra costs.
Yeah. So, like we said, this past week, we saw one of those policies, and I've seen several of them throughout my career. But it's not something that is even beneficial to the client, and I don't even know why the products are sold anymore.
So in that case, it would be beneficial to do a 1035 exchange, get a product that is actually going to grow with guarantees, not going to go down over the years, and that way you can get the time on your side today instead of waiting for that point in the future, which is inevitably coming.
Yes. In the olden days, they called this variable whole life. I don't see that term on these newer products that I'm seeing being sold, but that means that the premium can jump around on you, and it does. And so you want to be really careful and go watch our video on how to read a life insurance illustration before you sign the dotted line, because it's very important that you understand what you're getting into when you buy a life insurance policy.
Yeah. So some of the pros and cons, if we want to look at that with the 1035 exchange, the value can come to a new policy. The cost basis transfers to a new policy. By the way, what does that cost basis do when it transfers to the new policy? I mean, it doesn't change what's in and out of your pocket today, but what does it do when you start taking money out of the policy in the future?
Well, remember
Passive
that
income.
life insurance is treated special by the IRS. It's first money in is the first money out. And so those first premiums you paid on that first policy that you've now 1035'd into the second policy are still there on the books. So you get that adds to the amount of money that you can withdraw from this policy later on without paying taxes on it. So you can pull all the money you paid for the first policy and all the money you paid for the second policy out of that second policy without ever paying a dime of tax on it. Now, of course, we know that if you borrow from a policy, there's never any taxation. But it's nice that you didn't lose all those premiums that you paid the first time. When it comes to time in your life to start withdrawing this money to live on or to augment your golden years.
There we go. So continuing with the list of pros for the 1035 exchange, obviously if you have a universal life contract or even a whole life that is not performing like it should, was not designed the way it should have been to begin with, you can roll that with the 1035 exchange to a policy that is going to be in your best interest.
Some of the things that we need to consider here, though, John, is age is a big factor here. If you come at the time that your cash values have already disappeared in your first policy, it probably means that you're between 65 and 75 or even older, and the cost of the insurance in the new policy may be prohibitive at that time, depending on what your health is. So the sooner that we do this, the better. You don't need to wait until the cash values zero out. You can see what's happening, and you have to decide, am I going to continue to put good money after bad into this policy, or am I going to just cut my losses right now, take a small loss today, get a 1035 exchange in effect, and go from here on a solid guaranteed basis.
That's a really good point. And, that brings us to the list of cons then for a 1035 exchange. Age. You might be too old for that to make sense anymore. Time, you definitely want, if it makes sense, you definitely want to do that sooner than later. Otherwise, you're giving up compound growth on the new policy.
Absolutely.
If it's that much better. The other, some more cons you have to consider with 1035, sometimes there is surrender fees. That you typically see that with universal life if you're rolling out of universal life insurance.
Well, that's what I was suggesting, that, you may have some surrender fees early in the policy, but if you can see where this policy is headed, you may save more money by losing a little bit today than keep putting good money after bad and lose a lot of money later.
Mm-hmm. And the other thing is if you have a good whole life policy, and you think you find a better one, maybe the dividends are higher or whatnot, is it worthwhile doing a 1035 exchange in that case? One of the cons is that you do lose time with the 1035 exchange. The time that you had into the old policy, you're starting fresh with a new policy at that point, except for the value that's coming over. You have to look at if it's really worth losing the growth on the compounding curve that you're looking at. We have policies with a company who's not paying really great dividends. We have looked at 1035ing those policies over, but it doesn't make sense because the policies with the older company are already 10 years old or so. And the compounding growth that we would lose the first 10 years, it's not worth transferring to another company that's paying better dividends at this point. And this is something that a lot of agents will push. Unfortunately, when they switch companies, they'll try to get their clients to roll over the policies to the new ones, to the new company. And oftentimes, you're just losing time. So you really have to look at the numbers, make sure that makes sense.
So let's talk about that a little bit. Just because the agent that sold you a life insurance policy no longer represents the company that they sold the policy through, doesn't mean that you need to jump ship and do a 1035 into the new company's policy that your agent represents. This happens fairly frequently in the business, and there's it's an unethical action on the part of an agent to do that, but it happens. Just because something's illegal or unethical doesn't mean people don't continue to do it. So, if the first policy was good enough for them to sell, what makes it now bad simply because they can't sell that product to other people? Mm-hmm. So when that happens, or if you're in a situation where someone's recommending that you do a 1035 into a company simply because they don't represent that, then give us a call. We'll be happy to review both illustrations and let you see the facts behind the situation so you can make a proper decision. And it may be a good decision to do a 1035, and we'll tell you if it is. But if it isn't, we're going to point out the facts of why it might be in your best interest to stay with the original company. I'm thinking particularly of an example not too long ago where a client that had a policy that was 20 years old with a very well-known company out of the Midwest. I don't represent that company, and I don't know anyone personally that does. But the policy was written very well. And his dividends right now are paying his premium plus the interest on the loan he has on it.
That's pretty amazing.
That's huge. The dividends are very, very large. And the agent that sold that policy to him now no longer represents that Midwest company. He represents a company up in the Boston area. And he says, oh, that old policy, it's archaic, it's no good anymore, you need to roll it into this new company. And if he did, this client would lose a ton of dividends every year. And it makes no sense at all for him to do that. And when we explained the facts on it, the client was able to see it, and he's kept that policy, and he's very happy with it.
That's a good point. And you really have to look at your numbers and see what makes sense. When you look at the numbers, you see what's going on, it's pretty easy to make the right decision when you have all the facts in front of you. Something I'd like to touch on real quick that you would be that's good to know is what happens during the 1035 process. So when you actually go to do a 1035, the way it happens is on the application, there's a question that asks if you are replacing an application. Generally, your agent will fill this out, collect the information on the old policy, say you are contemplating a replacement. Then what happens is the old company gets notified that you're thinking about doing a replacement. And so they oftentimes during the process too, an in-force illustration may be requested. So your old company may get notice of that and want to contact you to talk over the options with you. Sometimes the insurance company will contact the agent, and the agent that first sold you the policy will contact you. So that's the process that they go through. That's an effort to make sure that it's in your best interest to switch the policy from the old company to the new company. Ultimately, it is your choice. So you have to be the one to look at those numbers and see what makes the most sense.
And you don't have to talk to the first agent that sold you the original policy. You don't have to talk to the insurance company's representative if you're just really determined that this is going to be in your best interest, but it is a way of safeguarding against the churning that we were talking about earlier, where you just take one policy and because you now have moved to another company, you bring your clients with you.
Yeah, that just doesn't make sense as a business model, but some does happen out there. So switching gears a little bit, I was talking with Dr. Jim recently, and he listens to this podcast on a regular basis, and he said he brought up something. I said we should address that on the podcast, because if Dr. Jim has this question, there's a chance that a lot of you have this question as well. So the question goes back to he is listening to the podcast. We were talking about using a policy loan for a down payment on a piece of property. Often makes a great sense to do that even when interest rates are low, and you can get a bank loan for the rest of the piece of property at a much lower interest rate. You can still take the down payment from the policy loan. That's what we did to when we purchased the house that we're living in now.
Yes, and other times it doesn't make sense to do that, because if I've got several $1,000s sitting in a bank doing nothing, and I'm going to buy a piece of rental property, or I'm going to buy a new home, does it really make sense for me to borrow from the policy when this money is just sitting there doing nothing?
Or does it make sense for you to buy a new policy and put all that money sitting there doing nothing into the new policy and borrow it right back out to go make your deal?
Well, now we're talking about money management.
Yes.
And that's what Life Benefits is all about, not just selling life insurance. We've used the life insurance as a tool in better money management. So let's say that you have $100,000 that you could buy a rental property with. And buying a life insurance policy with that first would only allow you to access $80,000 or maybe $90,000 if someone put a term writer on the policy but that's still not enough money for you to buy your rental property. And if you're a really good rental property manager and are making a 10 or 12%, you just blew the opportunity to make 10 or 12% on your money. And the life insurance policy will not make that return for you. It will not make up the difference. Right. So it doesn't make sense in that situation to put your money, your $100,000, into a policy first and then borrow it back out to make the property purchase, because you won't have the money to do it, and you just passed up on a great opportunity to make 10 or 12%. Now, what if you already have $100,000 of cash value in a life insurance policy? You don't have any savings outside the policy. Does it make sense to borrow from the policy for the down payment, or to maybe even make that full purchase on the rental property?
Certainly.
It does, because you now have the ability to go in and make a cash offer, which probably means that you're going to get ahead of the people that are having third-party financing. You're going to get the property, and if your interest rate on your policy loan is higher than what you can get a loan at a bank, you now can go back to the bank and refinance that property and pay your policy loan off with the bank loan.
Okay. So in some situations, yes, it makes sense to take the policy loan and go buy that piece of property. And if you have the money outside the policy, though, it's all about the wise money management. And the biggest difference in this is time. If you have that $100,000 or whatever it is sitting in an account waiting for a deal, but you have no deal handy and you might not for 5-10 years, yes, it's worthwhile to get that money into a policy, then go ahead and take the down payment from it when you do find your real estate deal. You don't know the timing in advance. That's the way to go.
Now, we're assuming that you already have life insurance in both of these examples. Because if you don't, you are entering into an area that's exposing you to a liability. And you don't want to leave a liability to the people that you love and cherish. So if you need to take your savings and buy a piece of a property or make an investment with it, you've got to make sure you've got some type of coverage to replace that money if you should lose it. And the best way to do that is with convertible term insurance, because it's very inexpensive and it's not going to deter you from making your investment. So, and then once the investment starts producing a profit for you like you expect it to, you can take the proceeds of that investment and convert that term insurance into a whole life product, so that the next time this comes along, you will have the money in your life insurance policy to exercise the option of taking a policy loan to make that purchase.
Yeah, that's good. I'm going to play devil's advocate real quick, because there's lots of people that say, well, you should, since the term insurance was so good to start out with, you should continue using the term insurance and never get the whole life insurance, because you'll be able to make more on your investments without it.
Well,
What's the other side of this coin here?
That's been proven wrong so many times. We don't really have time to delve into that, but you can certainly go to our YouTube channel and look at the different types of insurance video, which is going to clearly show you that as time goes on, term insurance is the most expensive insurance you can buy.
Yes.
If you're going to keep it for your entire life period. Whole life insurance has a level premium. Participating whole life insurance has a level premium for life if it's designed right. And, you have the option in the future of even stopping paying premiums out of pocket when the policy gets sufficient growth in it that it can take care of those premiums on its own. Term insurance never happens that way. Mm-hmm. It always gets to a point where it is cost prohibitive for you to purchase it. And we always just ask, when do you not want a death benefit? And when you ask the question that way, the people that we choose to work with always say, I always want a death benefit.
Yeah. And with the term insurance, if you stretch out those costs and compare them to the cost of whole life insurance, there is a break-even point on whole life where your equity or cash value in the contract is more than what you've ever paid in premiums.
Yes.
That never happens with term insurance. So usually right around numbers we've run, somewhere between year 9, year 10, somewhere right in there, is when you'll see the break-even point where it makes sense to get the whole life insurance and not just the term. Term insurance is a short-term solution.
And of course, that break-even point between cost basis, what you've paid for the policy, and guaranteed cash values is going to vary with your age and your health. So if you're in really good health and you're 35 to 55, it's going to happen much sooner than if you're in poor health and in that same category. Or if you're older than 65, it's going to take a little bit longer than 10 or 12 years.
Yeah. The buy term and invest the difference strategy was first tried out by A.L. Williams a number of years ago. That did not work for many people, and it doesn't work any better today. You have to look at the numbers. The term insurance never recoups that cost.
And one of the main reasons it doesn't work is people are not disciplined enough to actually invest the difference. But again, even if you do, why do you want to throw away the opportunity to add a death benefit? It becomes such a powerful tool in estate planning and everything else. If you've got a death benefit when you're in your late 60s, early 70s, and 80s, than if you don't.
Yes, it gives you more passive income options too if you have money in a whole life policy with that death benefit than if you don't. Term insurance is throwaway insurance at some point.
It also gives you a huge opportunity for charitable giving and to pass an inheritance off to the next generation with no taxes. Whereas if you've built a large investment portfolio and whatnot, it's very difficult to pass that off to the next generation without suffering some type of tax slippage. But if you've got a death benefit, then we can exchange those two, and the next generation doesn't suffer simply because you decided that you didn't want a death benefit after you were 65.
Yeah, that's a really good point. You have to think long term beyond. If you're building generational wealth, you have to think just beyond the first generation.
Oh, absolutely,
it's absolutely important.
And of course, the people that we choose to work with are very much into the idea that this isn't just for me. Mm-hmm. The just for me generation passed, I hope, in the 60s, where we were just looking out for ourselves. And hopefully now most people realize that the way to really create wealth is to always be trying to assist other people and create value in their life. And those are the people that are gravitated to life benefits, and we're delighted to work with them because they realize the bigger economic picture, that we can't just be looking out for number one all the time. We've got to be focusing on what can we do to bring value to other people.
That's right. So if you need the policy review that we talked about earlier in relation to the 1035 exchange, or you want to talk with us about your personal situation, give us a call at 702-660-7000. That number again is 702-660-7000. Be sure to tune in next week on the podcast. We have our CPA, Jack Cohen, fresh off the 2018 tax season. He's going to be sharing some thoughts with us about what he is seeing filing a lot of returns under the new tax law. Firsthand, that information is coming up next week.
And don't forget May 4th, Star Wars Day, we will be in Atlanta. And don't let Atlanta be too far away from you. We have people coming from Chicago and up the East Coast. So it's great if you're in the Atlanta area, but it's the first time we've been east of the Mississippi for several years. And take opportunity of that and get to Atlanta on May 4th, and we'll look forward to seeing you.
That's right. I'll put the link to the May 4th event right in the podcast resources. You can also call our office to get the information. Again, 702-660-7000. We'll be back next week. You are listening to Wealth Talks. Have a great week.